Good morning, everybody, and welcome to our last financial reporting webinar for this financial year. So it's disclosing the impact of implementing IFRS 16, and we will continue on a series around disclosure requirements of IFRS 9, 15, and AASB 1058 from next month. So very exciting. IFRS 16 is creating havoc in the market. A lot of people asking about it, a lot of people doing impact assessments, but what do we have to disclose? So a little bit of an introduction. Just before I go ahead, I thought I might just check if you could please let me know whether you can hear me. In the chat box, in the question box, maybe just say, Aletta, we're good, we can hear you, we're fine. I'll tell you why. As you know, Kevin and I usually present these webinars together, and somehow Kevin can't hear me today, so we've got some problem there. Okay. Other people are sending messages, we can hear you. That's fantastic. I think we're going to lose Kevin for the day because he's struggling with some login issues. But as long as you can hear me, that's great. All right. So if we look at IFRS 16, this webinar is specifically focused on the disclosures by lessees in their financial statements. So disclosures by lessees are the focus of this particular webinar. We're not looking at the disclosures of lessors or for sale and leaseback transactions because that is separate disclosure requirements and not the big change in IFRS 16. As you know, the effective date of IFRS 16 is for years beginning on or after 1 January 2019. So if you've got a 31 December year end, you are already within that first year of implementing IFRS 16. And if you've got a 30 June year end, 1 July, your date of initial application is literally just around the corner. A little bit of an overview, as you also know, we've been doing a number of webinars over the last 2.5 years around IFRS 16. In fact, the very first webinar I did at BDO was in January 2017, and it was on IFRS 16. And then over the next 2.5 years, we followed it up with a number of webinars around the impact of IFRS 16. Today is really rounding it all off and looking at the disclosure implications. I think it's very timely because if you prepare 30 June 2019 financial statements, you will have to disclose the impact of this new standard. Although you've not early adopted it, although you've not implemented it yet, but what will the impact be in future financial years? Now, a little bit of an overview of IFRS 16. From an earnings perspective, we know it will lead to a higher EBITDA. We know in future we won't have an even impact on profit and loss. We know the impact on profit and loss in the earlier years would be a lower profit and loss because we have an amortization table around the lease liability that will give you big interest expenses at the start and smaller interest expenses at the end. When we look at the statement of financial performance, we know there will be higher assets because we've got right of use assets on the balance sheet. We know we'll have higher debt, lease liabilities. But a critical point is we know that our current asset position will deteriorate because our right of use assets will be non-current assets, and we know our lease liabilities will be split between current liabilities and non-current liabilities. So if you look at current assets, there are no new current assets, but there are new current liabilities. So net current assets would deteriorate. If we look at the cash flow statement, we'll know that there will be higher operating cash flows. So this is looking at the different sections of the statement of cash flows. Altogether, ultimately, your cash flow is is unaffected. However, the way you disclose it is there will be higher operating cash flows because we know that your interest cash flow will now be a financing activity, as well as the repayment of the liability will be a financing activity. A few other implications. The new leases standard could have an impact on your bank covenants, depending what they are. What are the ratios in your bank covenants? We know the new standard could have an impact on bonus arrangements, and maybe entities should think about how they structure bonus arrangements of senior staff and key management personnel. And we also know that IFRS 16 will require some system changes. Going forward, organizations will now have a leases register, very similar to how they currently have a property, plant, and equipment register. And that will be subject to audit. And there will be depreciation of these right-of-use assets, and there will obviously be amortization tables for each and every lease liability. So high level, some of the changes we expect to see under IFRS 16. So that's an introduction. What will we be doing in today's session? Now, in today's session, the focus is on disclosure in the records of the lessee, and I want to do it in 4 parts. First of all, I want to talk about the 3 different transition methods. Now, we've talked about this extensively in a previous webinar in September last year. However, I just want to recap that very quickly because there is a link between the 3 different transition methods and the disclosure requirements. Then I'll look at disclosure of the impact assessment. So if you've not adopted IFRS 16 yet, you still have to disclose the impact assessment in 30 June 2019 financial statements. I'll talk about transitional disclosures. So as soon as you implement a new standard, there are some disclosure requirements when you move from an old standard to a new standard to reconcile for users what's actually changed at that date of initial application. And then also, lastly, we'll talk about the ongoing disclosures in terms of IFRS 16. So not on the date of transition, not in the first year, not currently, but ongoing in future. What is the information you have to disclose every year in respect of each and every lease? So let's kick off and let's look at the 3 different transition methods. Now, first of all, when we look at transition methods, there are 2 main methods, and a lot of people would say there's only 2 methods, and that's being full retrospective and modified retrospective method. In actual fact, if you look at it very closely, you'll see that the modified retrospective method consists of 2 alternative ways to deal with the right of use asset. And therefore, realistically, there's 3 transitional methods available. So if we just look at full retrospective method, that's where your comparatives will also be recalculated, restated. The cumulative effect of all the leases before the beginning of the comparative year would be adjusted against opening retained earnings at the beginning of the comparative year. There will be a third statement of financial position at the start, presented at the start of the comparative year, and there's very limited transitional relief available. Now, currently at BDO, we are helping a lot of clients getting ready for IFRS 16, in particular because we've got a technology solution and we do BDO lease management services. It's very interesting. Of all the clients we're looking at, I only have 1 client that's actually elected to use the full retrospective method, and they want the comparable information over time, and it's a big exercise. I should also say that that particular client has very good quality of information, so they can go back and get all the information required to apply IFRS 16 retrospectively. By far, so all our other clients where we're assisting them with IFRS 16 are looking at one of the 2 modified retrospective methods. where the comparatives are not restated. So the comparatives are still the comparatives as prepared under AASB 117. The cumulative effect is recognized as an adjustment to opening equity at the start of the current period. So the date of initial application. So if we take an example with an entity that have a 30 June year end, mandatory application, mandatory date of initial application for them will be 1 July 2019. And therefore, the cumulative effect would be an adjustment to retained earnings on 1 July 2019. A third statement of financial position is not required. That's one of the benefits of the two modified retrospective methods. And then the lease liability calculated for both modified retrospective approaches are the same. However, there's two alternatives to determine the right of use asset. You can do this on a lease by lease basis. However, I have to say that our clients are actually picking modified retrospective 1 holistically or modified retrospective method 2 to all their leases. I've not come across a client that's done it on a lease by lease basis, although it is possible. However, there's such a complicated calculation, so much work to get ready. I think that's an extra layer that people, just don't have the time for at the moment. But it's something to consider. And then there's more extensive transitional relief available, which is very important. If you do the modified retrospective approach, where you're just fixing the first year, there are some transitional relief to assist you with the calculations, to potentially make the calculations easier and simpler to do. So if you look at the retrospective application options for lessees, there's the full retrospective approach and there's the modified retrospective approach. In this diagram, we just lay it out slightly differently. Modified retrospective approach number 1 at BDO, we've branded it number 1 because the other way to refer to it is paragraph and a whole list of numbers. And that is basically the approach where your right of use asset on the date of initial application equals the lease liability, less the accrual or prepayment that you've booked until 1 July 2019 in terms of the old AASB 117. So I might explain that a little bit more. Currently, under AASB 117, entities will work out an even operating lease expense, even though there might be fixed increases over time. And in order to get to that even operating expense that's different to the cash flow, entities would be booking an accrual or a prepayment under AASB 117. So under modified retrospective approach 1, when we do move on to IFRS 16, obviously that accrual prepayment have to be removed. So you would calculate your lease liability, you would adjust the lease liability for the accrual or the prepayment, and that will give you your right of use asset. If you look at modified retrospective approach number 2, the lease liability calculation is the same. It's the net present value of future lease payments. However, the right of use asset is calculated on a retrospective basis. And there are a number of practical expedients available to make that calculation easier. And also the other main thing is that you use the prevailing incremental borrowing rate at the date of initial application. So you don't have to go back and look for the incremental borrowing rate when you entered into all these various leases. It's really important, and that's why I'm redoing a little bit of this. It's really important from a business perspective that entities consider which of these transitional approaches is best for them. Now, different entities have different needs, different pressure points. All three of these are available. Often, when we work with clients, we actually run the numbers in terms of all three approaches if they have good information available to do full retrospective approach, I should say, but at least run the numbers under modified retrospective approach number 1 and modified retrospective approach number 2, and clearly look at the impact on the date of initial application 1 July 2019, as well as the impact over the next 5 to 10 years to see what's going to happen. So it's really important, even when we look at disclosures, to consider whether you've decided on a transitional approach. I think it's really important that finance teams consult with the board or the audit and risk committee or the audit committee to decide on an approach that's best for the business and the business needs, and not necessarily just the easiest approach. So full retrospective method, it gives you beautiful comparable information. If you look at the two modified retrospective approaches, it's definitely simpler due to more practical expedience to help you with easier calculations. But I think it's important to look at two aspects: the impact on retained earnings at the date of initial application, and also the impact on future profit or loss. Because between the two, it will give you a clear indication which is best for your organization. A more visual representation of these methods is the following. So when you look at full retrospective method, this will be you apply AASB 16 or IFRS 16 on lease commencement date. So you have to go back to the start of each and every lease and apply AASB 16 from that date. So you need really good information. So you'll go through all the green circles to determine the lease liability. You always determine the lease liability first. And then you use the lease liability as a starting point and make a number of adjustments to those to determine your right of use asset. And that's the red number of circles. But you go back in time. So comparatives are restated as if IFRS 16 had always been in effect. The disclosure, you'll disclose it in the current year under IFRS 16, your comparative year under IFRS 16, and the retained earnings at the beginning of the comparative year, you also fix that and disclose that. If we look at another visual representation of modified retrospective method 1, again, you start with the lease liability, but this time you determine the lease liability at the date of initial application. So the previous one, full retrospective, you determine the lease liability at the commencement date of the lease. Here, we actually look at the lease liability at the date of initial application. For most of our clients, most clients have 30 June year end, and therefore date of initial application 1 July 2019. Then we make adjustments. And that is, we want to get rid of whatever prepayment or accrual we had under AASB 117 to get to that even operating expense in the olden days. And the difference between that will give you the red circle, the right of use asset. If an entity did not book an accrual or a prepayment in the past, maybe it was not a material number, and therefore they didn't book it, your lease liability under modified retrospective method 1 will just equal your right of use asset, and we've seen that with a lot of our clients. In this slide, I just explain a little bit of the calculations, maybe put a few more words around it if you want to look at that. If you look at modified retrospective method 2, here again, we look at the lease liability, and again, it's the lease liability that we've determined at the date of initial application. So lease liability at the date of initial application. However, then we take that lease liability at the date of initial application, and we go back and we look at initial direct costs, cost to restore or remove. We look at payments made at or before commencement date. We look at lease incentives received, and we come up with our right of use asset. So I think very important here is you have a lease liability at the date of initial application that's forward-looking. However, in order to get to the right of use asset, you have to go back in time and do a calculation for the right of use asset part retrospectively. So very important, your lease liability is calculated as in the same way as under modified retrospective approach 1. So it's forward looking. It's the net present value of the remaining, the future lease payments. And it's the incremental borrowing rate at the date of initial application. So it's all date of initial application. However, your right of use asset is recognized as at the date of initial application, as if IFRS 16 had always been applied. However, remember, you still use the prevailing incremental borrowing rate at the date of initial application. I just want to say a lot of people would say, Aletta, why would we do modified retrospective method number 2? It is quite a complex calculation. We do have to go partially back in time, especially for the right of use asset. Why would we not just do modified retrospective method 1? And there's a very good reason for it. Modified retrospective method 2 has a smaller impact on your profit and loss in future because your depreciation is pushed before the date of initial application. If you look at modified retrospective method 1, although it's simple and there's no adjustment to retained earnings on the date of initial application, it in effect pushes the depreciation to the future. Therefore, it depends on what your pressure point is. Is your pressure point retained earnings, opening balance, date of initial application, or is your pressure point future profit and loss? Also on transition, there's a number of practical expedients. And the first one is around the definition of a lease. And this practical expedient is available for all the transitional methods. And really what it's saying is if you've previously made an assessment on whether an agreement meets the definition of a lease, and you've applied AASB 117 and Interpretation 4 correctly, you can grandfather that analysis and determination. And you will only apply the AASB 16 definition of a lease to all your new contracts. I have to warn you, big warning, you cannot grandfather the fact that you've never done an assessment, that you never considered whether there's a lease in certain service agreements. You also cannot grandfather an incorrect assessment of the past. So be careful of this practical expedient. Then, for the modified retrospective methods, there are 5 more possible practical expedients, and we'll look at them one by one. And this is just a summary of the 5 other practical expedients. So practical expedient number 2 is we apply a single discount rate to a portfolio of leases with reasonably similar characteristics. So if it's not used, what will you do? You'll determine an incremental borrowing rate on date of initial application for every lease contract. However, you could say, I'm going to use a single discount rate to a portfolio of leases with similar characteristics. For example, a similar discount rate to all our vehicle leases that have a similar term. Often our clients have fleet vehicles that's, the remaining term for all of them is another 2 or 3 or 4 years. So it's possible to use a single discount rate and you don't have to use an individualized one. So if you use it, what will you do? Leases with reasonably similar characteristics may be pooled together and you apply that discount rate to your pooled leases. If you look at your practical expedient number 3, you use your onerous lease assessment and any provision recognized immediately before the date of initial application instead of an AASB 136 impairment test. So you know, in this scenario, if you don't use this practical expedient, in a perfect world, you would apply AASB 136, impairment of assets, to all right-of-use assets when you first adopt AASB 16, because AASB 16 applies to the impairment of all non-financial assets, and you'll have to do that assessment. To make it a bit easier and faster on the date of initial application, they could say, listen, let's look at the assessments we've made in the past on onerous leases and any provisions we've created for onerous leases, and let's run with that. Because you would have done that assessment at 30 June 2019. Let's run with that on 1 July 2019. So that is very important. So you'll reduce your right of use asset by your previously recognized onerous lease provision, but you don't redo an impairment test on the top of that as well. If you look at practical expedient number 4, it is to exclude initial direct costs from the measurement of right of use asset at the date of initial application. So if it's not used, you know, depending on your approach to calculate right of use asset, your initial direct cost incurred by the lessee on commencement of the lease and needs to be determined. However, if you use this, the amount of initial direct cost incurred by the lessee on commencement of the lease does not need to be determined. To be honest, all our clients prefer to use this practical expedient because maybe they don't have adequate records to go back to the initial direct costs. If you look at practical expedient number 5, there's no need to recognize leases whose term ends within 12 months of the date of initial application. You know, so if there's less than 12 months left, don't bring it on the balance sheet and then remove it immediately. However, you could decide to bring it all on the balance sheet as well. And then practical expedient number 6 is around the use of hindsight. So this is use hindsight, such as in determining the lease term if the contract contains options to extend or terminate the lease. So, you know, if we've reassessed in the olden days the lease term constantly, on the date of initial application, we would say, listen, let's use hindsight. And on 1 July, what is our latest assessment? Whether it's reasonably certain to exercise options, whether it's extension options or termination options. So the use of hindsight is particularly useful and saves a lot of time when we do these calculations. So this is a bit of a summary of all the practical expedients that are available and when they would be available with the different transitional methods. So after all of that, and I must say, I know I've done this webinar before on transitional requirements, but I'm extremely passionate about these because if you don't get the transitional requirements right, you really have a problem in future potentially in your financial statements and communicating it to users, and it's a lot of work involved. So I think it's a really important decision and a decision that have to be made as soon as possible, and actually the first decision you have to make around the implementation of IFRS 16. If we move on to the next section, which is the disclosure of an impact assessment, this is particularly focused on how do we disclose an impact assessment in a financial year where we haven't yet adopted IFRS 16, but IFRS 16 obviously has been issued by the standard setters a few years ago. We haven't adopted it yet. We want to warn our users about the potential impact. We want to flag the potential impact. So how do we do that? First of all, where does that disclosure requirement come from? And it comes from AASB 108 around accounting policies, prior period errors and changes in estimates. And AASB 108 paragraph 30 specifically says, when an entity has not applied a new accounting standard that has been issued but is not yet effective. So this IFRS 16 has been issued years ago. It's only effective if you've got a 30 June year end from 1 July 2019, this is what you have to disclose. Sorry, I just want to take a sip of water to get rid of this irritating cough. You have to disclose this fact, the fact that there is a new standard and you have not yet implemented it because it's not yet effective, so the fact. And then you have to disclose known or reasonably estimable, oh, I can't say that word, definitely too much for my Afrikaans. So a reasonable estimate relevant to assessing the possible impact that application of this new standard will have on the entity's financial statements in the period of initial application. So first of all, we haven't implemented it yet, and we have to disclose an estimate of what the impact will be in the first set of financial statements where we will be implementing it. Then in paragraph 31, they say in complying with paragraph 30, an entity should consider disclosing the following. So it's a little bit of a recommendation. The title of the new Australian accounting standard, the nature of this change or changes in accounting policy, the date by which the application is required, the date as at which it plans to apply the standard initially, and then either a discussion of the impact that initial application is expected to have, or if that impact is not known or you cannot come up with a reasonable estimate, a statement to that effect. Now, these are general requirements around new accounting standards. What I've included in here as well is our regulators' expectations. Now, ASIC is actually, and if I open it up, on Monday this week, ASIC has issued their, it doesn't want to open up, but ASIC has issued their media release, their focus areas for 30 June 2019 financial statements. That's the link. I think I would highly recommend that you look at this document on what will ASIC be looking at. I've summarized some of the key things as it relates to IFRS 16. They specifically say the reports, this is 30 June 2019 reports, must also disclose the future impact of new lease accounting requirements. So very specifically, the ASIC commissioner said that new accounting standards can significantly affect results reported to the market by companies, require changes to systems and processes, and affect businesses. Now, we've spent webinar after webinar talking about exactly that, how it affects the business, what changes are required to systems and processes, and how it impact what you communicate to your users. And then they go on to say, it is important that directors and management ensure that companies inform investors and other financial report users of the impact on reported results. Required disclosure on the effect of the new standards is more extensive than that made by companies for the 31 December 2018 half year. Now that red bit, and that is my red that I've added, but I've extracted it from the ASIC media release, is in my mind a little bit of a warning. And they're saying, hang on, in the past, entities made quite limited disclosures on what IFRS 16 would do to their financials. And even in the half year, which was just a few months ago, there weren't significant disclosures. And ASIC is saying, listen, that's not good enough. So if you get to 30 June financial reports, and if you finalize that by the end of September or end of October, you are already 3 or 4 months into the new financial period where you've actually implemented the standard. So it would be quite unacceptable to say that you don't know what the expected impact is because you've already implemented on 1 July 2019. And then ASIC said, and remember, we'll be reviewing more than 200 full year financial reports to promote quality financial reporting. And I think a very important point, useful and meaningful information for investors. And of course, you know, if you have a lot of leases, if you have long-term leases, you know, from a business perspective, we've been recommending you to disclose the information as soon as possible to the market and the users, which I think it's important to disclose it as soon as possible rather than wait for the shock 30 June 2020. Some example disclosure. Now, the first one is you could disclose the directors have undertaken an assessment of the impact of AASB 16 and anticipate that initial adoption of the standard will not have a material impact on the entity's financial statements. My question there in the yellow block is, do we have sufficient appropriate audit evidence to support that statement? And that little yellow star is not a reminder for the auditors. It's actually a reminder for clients to say, if you want to put that in your financial statements, if you want to say the directors have made this assessment and it doesn't have a material impact, can you back it up? Because ASIC can come knocking on your door and say, listen, based on our rec or way we read your financials, you've got thousands of leases. How's it possible that it doesn't have a material impact? Obviously, for auditors, if you want to include that disclosure in financial statements and sign off an unmodified audit report, do we have sufficient appropriate audit evidence? The alternative, which is the better alternative, and I think quite often the case, is the directors have undertaken an assessment of the impact of AASB 16 and anticipate that initial adoption will have a material impact on the entity. The directors estimate that as a consequence of adopting AASB 16, and then you disclose the impact on right of use, asset, retained earnings, lease liability, ongoing profit, etc. So I think it's really important to do a full disclosure. No, do a full assessment, do an appropriate disclosure depending on whether it has a material impact or not. And whatever you put in the financial statements, do you have sufficient appropriate evidence to support that assessment? The next area that I want to look at from a disclosure perspective is transitional disclosures. Now, this would be when you first adopt IFRS 16, there will be new disclosure requirements in IFRS 16 of an ongoing nature, but obviously there will also be transitional disclosures. Where do they come from? They come from AASB 108 again, paragraph 28, which says when initial application of an Australian accounting standard has an effect on the current period or any prior period, would have such an effect except that it is impracticable to determine the amount of the adjustment or might have an effect on future periods, an entity will disclose the following. The title of the Australian accounting standard, the change in accounting policy that is made in accordance with its transitional provisions, the nature of the change in accounting policy, when applicable, a description of transitional provisions. And remember, with IFRS 16, we have potentially have extensive transitional provisions and practical expedients to assist with transition. When applicable, the transitional provisions that might have an effect on future periods. So really important on IFRS 16 is which transitional approach are you picking, and then disclose that method very clearly, including the practical expedients that you've used. Then when we continue, also have to disclose for the current period and each period presented, prior period presented, you have to disclose the amount of the adjustment for each financial statement line item affected. So what is the impact on interest expense, depreciation? What is the impact on right of use asset, current, non-current, lease liability, current, non-current? The amount of any adjustment relating to periods before those presented, you also have to disclose. and if retrospective application is impracticable, you have to disclose why. Now, if you look at these two slides, you can see that the disclosures we have here around transitional disclosures are all around full retrospective application. So if you use the full retrospective method, these are all the disclosures you'll have to make, because it's aligned to your normal change of accounting policy. I think this slide is more important in that most of our clients use modified retrospective methods 1 or 2. And if you want to know the transitional disclosures, you have to look at AASB 108 paragraph 28, which we've just discussed, as it is amended by AASB 16 paragraph C12 and C13. Because here they are saying if a lessee elects to apply the standard IFRS 16 in accordance with paragraph C5 little b, and basically paragraph C5 little b talks about modified retrospective methods 1 or 2. The lessee shall disclose information about initial application required by paragraph 28 of AASB 108, except for the information specified in paragraph 28F. Instead of that information in paragraph 28F, you'll instead disclose the weighted average lessee's incremental borrowing rate applied to lease liabilities. That's recognized in the statement of financial position at the date of initial application, and an explanation of any difference between, and this is a critical disclosure, an explanation of any difference between operating lease commitments disclosed applying AASB 117 at the end of the previous annual reporting period, discounted using the incremental borrowing rate at the date of initial application as described in paragraph CH(a), and lease liabilities recognized in the statement of financial position at the date of initial application. So the purpose of this particular disclosure is to say, listen, previously you had all these operating lease commitments, and now you bring all of those onto the statement of financial position. Why is there a difference between the two? Explain the difference. Basically do a reconciliation of the difference. So a very important disclosure. And if a lessee uses one or more of the specified practical expedients in paragraph C10, you should disclose that fact. So it's really important to consider in the first year of applying IFRS 16, have I complied with the disclosure requirements in AASB 108 paragraph 28, as well as the disclosures in paragraph C12 and C13 of AASB 16? And I want to flag it now because it's important when you input or implement new systems that your new systems can generate this information, so that you don't spend money on a new system and when you get to 30 June 2020, you cannot get the information required for disclosure purposes. And then if we look at ongoing disclosures in terms of IFRS 16, so this is after you've implemented IFRS 16. Every year, what do you have to disclose? So important ongoing disclosures in terms of IFRS 16. First of all, in your statement of financial position, you have to disclose your right of use assets. So if you have right of use assets that are investment property, for other underlying assets, you will disclose your right of use assets within property, plant and equipment, or you'll disclose your right of use assets separately. If you look at right of use assets included within property, plant and equipment, there's different ways that you can do it. You could say, here are my assets. I've got property, plant and equipment just in one number in my statement of financial position. And then in note 4, you can break it down a bit further. So if we move on to note 4, you can say there's a separate column for right of use assets vehicles and a separate column for right of use assets equipment. So it's really important to see here that you'll have a separate column for the property, plant and equipment that you own, and a separate column for the right of use assets, but it will be within the same note. Another way to do it is you could say on your statement of financial position, you could have property, plant and equipment, note 4, your normal property, plant and equipment, and you could have a separate line item, right of use assets, which you then further explain in a separate note. So on the face of the statement of financial position, it could be one disclosure or two separate disclosures, but the same detailed information will be in the supporting notes. If you look at your statement of financial position and we focus on the lease liability side, your lease liability, you'll distinguish between amounts due within 1 year and amounts due after 1 year. You will present it within line items for other liabilities, or you could present it separate from your other liabilities. Again, you can have it, what is the current portion of your long-term debt separate from the current portion of lease liabilities, or you can put it together on the face of the statement of financial position and then break it out in the notes. So again, that's your choice. So here, if you look at your liabilities, current liabilities, there's current portion of long-term debt and lease liabilities, so it's just one number. However, if you go to the note, you'll break it out in what is the current portion of long-term debt and what's the current portion of lease liabilities. So you have the choice when you present these leases in your statement of financial position to either have one line on the statement of financial position and in the notes you split it out, or you can have two lines in the statement of financial position supported by the various disclosures. Really same difference. If you look at the statement of comprehensive income, if you are preparing your statement of comprehensive income by function, you'll allocate the amortization of your right of use asset to cost of sales, distribution cost, and administrative expenses as appropriate. And you'll include your interest on the lease liability within your aggregate finance cost. If you're preparing your statement of comprehensive income by nature, you'll include the amortization on the right of use assets within the aggregate for depreciation and the amortization expense. Whether it's function or by nature, doesn't matter. You'll include interest on the lease liability within the aggregate finance costs, and you'll disclose in the notes depreciation charge on right of use assets by class of underlying right of use asset, and you'll disclose in the notes your interest expense on lease liabilities. So that's statement of comprehensive income. If you look at your statement of cash flows, previously our lease payments would have been in operating activities, and we now know that your repayment of your lease liability, which you can see right at the bottom, the 55,150, which I've circled, that repayment of lease liability is clearly a financing activity. And when you look at your interest part of the repayment of lease liability or the interest expense, it's an accounting policy choice whether it's a financing activity or part of operating activities. So there's a few alternatives, and you've got some accounting policy choices to apply in that situation. A few other disclosures. If you look at paragraphs 53 and 54 of IFRS 16, you have to specifically disclose the interest expense on lease liabilities. You have to disclose the expense relating to short-term leases. You may exclude leases with a term less than 1 month. You have to disclose expenses relating to leases of low-value assets, excluding short-term leases. You have to disclose the expense related to variable lease payments excluded from the measurement of the lease liability. As you know, when we calculate the lease liability, we only look at fixed lease payments or in substance fixed payments. As these variable lease payments get processed, market reviews, CPI adjustments, you have to disclose that separately in the notes. You have to disclose the income from subleasing right-of-use assets. Have to disclose that, and also if you've got any gains or losses arising from sale and leaseback transactions, disclose it separately. You also, they say in paragraph 54, you present the above in a tabular format unless another format is more appropriate. Then paragraphs 52 to 60 have additional disclosures to meet the overall disclosure objective of the standard, and that is you have to disclose your short-term lease commitments if it's different to the annual expense. You have to provide your IAS 40 investment property disclosures if your right-of-use assets or some of your right-of-use assets are actually classified as investment properties. If your right-of-use assets are revalued, you have to provide the relevant IAS 16 disclosures. You have to disclose a maturity analysis for your lease liabilities. There's also additional information required to meet the objective stated in paragraph B48. So you have to disclose the nature of your leasing activities, the cash flow exposures that's not included in the measurement of the lease liability. So that is variable lease payments, effects of options, residual value guarantees, all those things that were not included in the lease liability. Explain that. You have to disclose restrictions or covenants imposed by leases, and also sale and leaseback transactions have to be disclosed quite extensively. You also have to disclose whether you've used the short-term or the low-value recognition exemption. So I think that's really important. The disclosure requirements, just to recap, there are disclosure requirements now when you prepare your 30 June 2019 financial statements. And the disclosure requirements are around the impact in the next financial year. And that's an ASIC requirement, and ASIC will enforce that and highly recommend it, and do have evidence. Then from next year, and you have to start to get ready for that, next year you'll have to do transitional disclosures, and then from next year and all the years in future, you'll have to do these annual IFRS 16 disclosures. So BDO resources, you know about our webinars, which we run and which we have been running. This is the third year now. We've been running it since 2017, a number of webinars on IFRS 9, 15, and in particular 16. We've got great publications. I've provided the links to our website. A great publication on IFRS 16, IFRS in practice. We also have accounting news, our monthly newsletter, including videos where we explain various issues as we pick it up and flag it to our clients. And then a new resource or a new offering is we've just this month launched our online training courses, our e-learning training courses. You can see there are different aspects. There's a training course on presentation, which we've just discussed. There's a part on transition. There's even on lessor accounting. And I think it's really important, if you use these links, you can access the e-learning. It is free of charge. Available to anybody. This is just an example of what it looks like. You start the course and it's interactive, working through the main requirements of the standard. It's been developed by the IFRS advisory team globally, but also in conjunction with the BDO Australia IFRS advisory team. We've been the leaders in this space, so very proud of our e-learning. And by the way, the e-learning is also available for IFRS 9 and 15, and all of it is on our BDO Australia website. If you need assistance, I think it's important to do a little bit of a health check, and it's a good time to do a health check. Do you know which contracts contain leases? Have you identified your embedded leases? Are your systems and processes capturing all the required information? Do you have systems and processes to monitor your leases, keep track of the changes, CPI assessment, market reviews? And what information can you obtain from the lessors? Have you considered a transitional approach? Have you considered recognition exemptions? Have you considered practical expedience? Have you decided on discount rates to be used? Have you assessed the impact of the changes on your financial results and financial position? How will you communicate this to your stakeholders? And have you considered tax and other business impacts? I mean, so many issues around IFRS 16 to consider. As I've previously explained around BDO's service offering for IFRS 16, three main service offerings. The first one, BDO Lead, is our software as a service solution for entities with a large number of leases where they manage it themselves through the cloud. We help them with implementation and setup. There's BDO Lease Management Services where we manage the leases for you on an ongoing monthly basis. Suitable for if you've got up to around 100 leases, we can maybe push it to around 200 leases. And then impact assessment. If you need us to help you with an impact assessment, to do a disclosure in your 30 June 2019 financials, absolutely we can do that. And we use our BDO Lead tool to do that. Technical advice. The partners to contact in Melbourne or nationally, you can contact me, especially around BDO Lead. In Sydney, you contact Kevin. In Brisbane, Clark. In Perth, Wayne Basford or Susan Oldmeadow Hall. Our team, ever-growing team to implement IFRS 9, 15 and 16 and assess and assist our clients. Any questions, please send it through to me. I'm happy to address them. Thank you very much. I really appreciate you joining us. I wish you good luck for the preparation of your 30 June financial statements. Please contact me if we can assist you in any way. Please feel free to use all those resources, webinars, publications, e-learning. But if you need assistance, please contact me. Thank you very much for attending the webinar today. I hope you found the disclosures useful. Next month, we'll look at the disclosures around IFRS 15. We'll also look at IFRS 9 and the disclosures around AASB 1058 in the coming months. So we've really moved on to disclosures to try and help you to prepare your financial statements for 30 June 2019. Thank you very much. Have a good day.